I think we do have Nilesh Shetty from Quantum Advisors joining in. Nilesh, thank you very much for being with us. Let's start with your thoughts on this little bit of a shakeout that we've had in a market that got used to riding only one way, and that was up.
I mean, CY23 was a very strong year for Indian equities, and given where valuations are, at least our internal view is that returns over the next 2 years will be sort of much lower than what we've seen over the last 2 years. I think investors' valuations will act as a drag on equities over the next 2 years. There are pockets of opportunity. I think the consensus seems to be private banks. We've not seen those valuations for the last 2 decades for these banks. But barring that, if you go sector by sector, there are not many places there where you can build a long-term portfolio.
Okay. So what's the sense on, what is, first of all, your own positioning and stance on large cap banks right now? What is the weightage that you've ascribed to them? And do you think that the concerns that we saw from the HDFC numbers, do you expect that they could be relevant for the rest of the sector as well? Or is it just an HDFC bank specific problem?
I mean, there are issues within that bank that you mentioned where they are trying to absorb a large sort of parent within them, and there'll be a transition period. But generally, private sector banks as a cohort have underperformed as sort of names have come under pressure, spreads have narrowed. But it's, at least our internal senses, it's cyclical in nature. It's nothing structural where you expect much lower returns going forward from these banks structurally, or lower return on equity structurally than they've done historically. Our largest weight remains in private sector banks. So our BFSI weight remains at about 37% of the portfolio. And within that, the largest chunk remains the top 2 private sector banks in India.
Okay, that is banking. How are you looking at IT, given that we've had all this news flow, we've seen the earnings come in, and you have TCS pointing towards the recovery, Infosys being non-committal. So what do you make of things?
So IT was one sort of pocket of opportunity was where valuations were comfortable, but sort of last sort of 2 weeks, they've rallied a bit. See, again, given the disruption that is happening in the sector, and we have a large weight there in the sector, close to 16%, which we built once the stocks started correcting, so early 2022 and then early 2023. But you need to be a bit more patient. I think the visibility on catalyst is not that immediate. I think it might be a bit more slower grind than what people think. News flow has changed where now companies are a lot more positive, but for them to actually play out in the numbers might take a bit more time. So there is immediate euphoria on perception being changed, but I think the actual numbers may take a bit more time to come.
Nilesh, has your team ever looked at Oracle Financial Services?
Yeah, I'll not be able to comment on individual stocks, but yeah, we do track it.
Okay, and any broad thoughts without giving an opinion on whether you should go out and buy or sell it, but any thoughts on what's happening at Oracle Financial Services, which could have prompted this kind of a performance this time?
Product companies generally tend to be a lot more volatile than, say, service companies, and they could have sort of blowout years as well, and then suddenly there's a big dip. So in your numbers, when you want to model, you want to normalize the numbers and see where normalized numbers look at. So it tends to be a lot more volatile than IT services companies, and you need to be a bit more careful in terms of how you value these companies.
What about something like Zomato? We've seen the stock come off from the highs by about 12-15%. I think the high on Zomato was close to about 140%. So in the last few days, there's been a correction in these new age tech companies. Where do you stand on them?
Yeah, we track them quite closely. See, the style that we have in the portfolio is a value style where we want to have a margin of safety when we buy into these companies. Given that sort of cash flow creation still remains quite hazy, there is a theoretical model where if these companies, especially platform companies, can charge a slightly higher fee, the entire thing flows to the bottom line. But given the competition intensity, it's not that easy for them to do that. So at least we're still waiting and watching and need a bit more comfort on valuations for these companies to add them to the portfolio.
And defense, we've seen a correction even in these defense companies and some of the railway companies. Is it now an attractive opportunity? Because many people missed out on the, on the way up. So the, 10-15% kind of fall. Is that a good enough entry level?
The entire capital goods space is frothy, at least our internal view. I think the defense space is even frothier. I think investors need to be careful. The revenue is highly linked to the Government of India budget, so it grows at a certain number. To assume these companies can grow much faster than that perhaps is not correct. I think there are phases where suddenly this theme comes to, and it's a bull run theme. We've seen that in that 2003 to 2007 cycle as well, where suddenly these stocks pop up, and once you realize the growth rate is pegged to a certain number in the Government of India budget, you realize why you're paying 40, 50 times earnings for that. So at least we've not had any defense company in our portfolio, and I'll advise investors to be careful in that pocket.
We've also seen big pops in, auto names. 2023 was a big year for auto. Now, as we enter 2024, where do you stand on auto?
So our largest overweight relative to the index was actually consumer discretionary, and within that, auto was the largest weight. So last year, we had a fantastic rally in the auto stocks. We have started trimming some of these names where we think valuations are now hitting levels where upside could be limited. But we still continue to have a large weight there. We probably have trimmed about 10-15% of our holding in these names.
Okay. Nilesh, we'll leave the conversation here for now. Thank you very much for joining in. We will slip into a very short break on that note. Okay,